FOMC minutes come out yesterday. Markets, not too sure what they said. Some too hot, some too cold. That's coming up on 3 Minutes on Markets and Money. Yesterday, the markets did rally right into the 200-day moving average, sold off yesterday morning, did rally back almost to break even following the release of the Fed minutes, as really the Fed came out, gave a little something to both the hawks and the dove. They noted yesterday, I'm going to read from a couple of notes here, Fed officials judged moving to a restrictive policy stance was required and inflation was unacceptably high. Now that's clearly hawkish for the markets. Certainly doesn't suggest a Fed pivot at any time soon as they continue to fight that inflation fight. However, they followed that up with right behind it saying, judge that the bulk of the tightening effect yet to be felt, playing down lower commodity prices, cooling inflation. Now, that was a rather dovish statement there. That got the bulls excited that, well, maybe that means they're not going to hike as much. And of course, on that comment, the expectation of a 75 basis point hike in September fell to a 50 basis point hike in September. The committee could tighten the stance of policy by more than necessary to restore price stability. Again, kind of a hawkish statement, doesn't suggest they're going to stop lifting rates anytime soon, but could slow the pace because they said that participants generally judged that the bulk of the effects on real activity had yet to be felt. Now, we know that. We know there's about a 9-month lag on monetary policy, so what's already been done has not shown up in the economy yet, and of course, being more restrictive means they want to slow the economy, create an economic slowdown to slow demand that brings down inflation, and those lags associated with monetary policy effects will certainly do that. But again, as they continue to hike rates, that's continuing to backload that tightening into the economy. On the rate front itself, many officials saw the Fed could tighten more than necessary. Again, fairly hawkish, not suggesting they're going to stop hiking rates anytime soon, but that the pace of hikes would potentially slow here. Participants concurred future rate hikes would depend on incoming information, and that was the dovish twist that everybody was looking for yesterday. And again, this market's looking to point up just a little bit this morning, as the expectation that incoming inflation will mean a slower pace of rate hikes. Again, not a reversal of rate hikes, not reducing rates back to zero, not stopping quantitative tightening by any degree. Markets just hoping here the Fed won't hike as much. Now, again, that's kind of a dangerous statement because, again, markets are now back to where they were in September of last year. The difference, September of last year, the Fed is at zero interest rates and doing $120 billion a month in QE. Today, we're at 2.25% on Fed funds rate, going to 2.75 and extracting $95 billion a month in quantitative tightening. So, again, a very different environment. Meme stock traders are back. Bullish traders are back. This is the beginning of a new bull market according to a bulk of the headline articles coming out. Be careful with that assessment. Markets are still going to have to deal with a slower economic environment as we get into 2023. That means reduced earnings, lower profit margins, and ultimately, potentially, lower stock prices. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money with your FOMC Market Minute Update. See you tomorrow.